Investing is crucial for financial well-being. It is a fundamental step towards achieving financial independence and stability. It allows your money to grow over time, leveraging the power of compound interest and market growth. By investing, you can outpace inflation and secure your future, ensuring that your purchasing power remains strong. By investing wisely, you can achieve your financial goals, whether they are short-term or long-term. These goals might include buying a home, retiring comfortably, or even traveling the world. Additionally, investing can help you fund your children's education, giving them a brighter future. Investing empowers you to take control of your finances and build a more secure future for yourself and your loved ones. Imagine a seed planted in fertile ground, representing the initial investment. As you water and nurture it, it grows into a strong tree, symbolizing the growth of your investments over time. This tree will eventually bear fruit, providing benefits and returns for years to come. Similarly, investing is like planting seeds of financial security. Each investment is a step towards a prosperous future. Each investment is a seed that has the potential to grow and generate returns over time, contributing to your overall wealth. Investing is not just for the wealthy, it's accessible to everyone regardless of income level. With the right knowledge and approach, anyone can begin their investment journey and reap its rewards no matter how small the initial amount. Start small, stay consistent, and watch your financial future blossom into something substantial and rewarding. Remember, the best time to plant a tree was 20 years ago. This timeless wisdom applies to investing as well. The second best time is now, so take the first step today and start investing in your future. Investing simply means putting your money to work for you, allowing it to grow over time. Instead of letting your savings sit idle, you invest them in various assets like stocks, bonds, or real estate, with the hope that these assets will increase in value over time. This increase in value is known as your return on investment, which can come in the form of interest, dividends, or capital gains. Think of it like this: you lend your money to a company or government by purchasing bonds, and in return, they pay you interest or dividends. Alternatively, you can buy a share of ownership in a company through stocks, hoping its value will rise, allowing you to sell your share for a profit. However, investing involves risk, meaning the value of your investments can fluctuate due to market conditions. Despite these fluctuations, history has shown that investing in a diversified portfolio of assets, including stocks, bonds, and real estate, tends to yield positive returns over the long term. It's crucial to understand your risk tolerance, which is your ability to endure market volatility, and invest accordingly to match your financial goals and comfort level. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a small piece of that company. If the company performs well, its stock price tends to rise, and your investment grows. Conversely, if the company faces challenges, its stock price may decline. Bonds are like loans you give to a company or government. They promise to pay back the principal amount with a fixed interest rate over a specific period. Bonds are generally considered less risky than stocks but offer lower potential returns. Other popular investment options include mutual funds, exchange-traded funds, real estate, and commodities. Each asset class has its own risk and return characteristics, so it's essential to diversify your investments. Diversification is a risk management strategy that involves spreading your investments across different asset classes, industries, and geographical regions. The idea is to avoid putting all your eggs in one basket. Imagine investing all your money in a single stock. If that company faces unexpected challenges, your entire investment could be at risk. However, if you diversify your portfolio, a downturn in one investment is likely to be offset by gains in others, reducing your overall risk. Diversification helps to mitigate losses and enhance potential returns. By investing in a variety of assets with different risk profiles, you create a more balanced and resilient portfolio. Section 5. Managing investment risks. Investing always involves some level of risk. However, understanding and managing those risks is crucial for long-term success. One of the most effective ways to manage risk is through diversification, as discussed earlier. Another important aspect of risk management is understanding your own risk tolerance. This refers to your ability to withstand fluctuations in the value of your investments. If you're risk-averse, you may prefer more conservative investments like bonds. If you're comfortable with higher risk, you might consider allocating a larger portion of your portfolio to stocks. It's also essential to invest for the long term. Short-term market fluctuations are inevitable, but over time, the market tends to trend upwards. By staying invested and riding out the ups and downs, you're more likely to achieve your financial goals. Section 6. Your investment journey begins now. Starting your investment journey is easier than you might think. The first step is to define your financial goals. What are you saving for? How much money do you need and when will you need it? Once you have a clear understanding of your goals, you can start developing an investment plan. This plan should outline your investment strategy, including your asset allocation, risk tolerance, and time horizon. Next, choose an investment platform that suits your needs. There are numerous online brokerage accounts, robo-advisors, and financial advisors available. Consider factors such as fees, investment options, and the level of guidance provided. Section 7. Avoiding common investment pitfalls. Investing can be daunting, especially for beginners. It's easy to make mistakes that can cost you money. One common mistake is investing based on emotions rather than logic. Fear and greed can lead to impulsive decisions that harm your long-term returns. Another common pitfall is chasing past performance. Just because an investment has performed well in the past doesn't guarantee future success. It's essential to conduct thorough research and make informed decisions based on your financial goals and risk tolerance. Finally, avoid timing the market. Trying to predict when the market will rise or fall is extremely difficult, even for experienced investors. Instead, focus on a long-term investment strategy and stay invested through market fluctuations. Section 8. The power of compound growth. Compound growth is the snowball effect of earning returns on your returns. It's like a snowball rolling down a hill, gathering more snow and growing larger as it goes. When you reinvest your earnings, they generate their own returns, leading to exponential growth over time. This means your money starts to work for you, creating a cycle of continuous growth. Imagine investing $1,000 with a 10% annual return. This is a simple example to illustrate the power of compounding. After the first year, you'll earn $100 in interest. This might not seem like much at first, but it's just the beginning. If you reinvest that $100 in the second year, you'll earn interest on the original $1,000 plus the $100, resulting in $110 in interest. This is where the magic starts to happen. This cycle continues with your earnings compounding over time. Each year, your investment grows larger, and the interest earned increases. The earlier you start investing and the longer you stay invested, the more significant the impact of compound growth. Time is your greatest ally in this process. Even small contributions made consistently over time can grow into substantial sums thanks to the magic of compounding. It's a powerful tool for building wealth and securing your financial future. Section 9. Long-term perspective. Investing is a marathon, not a sprint. It's crucial to adopt a long-term perspective and avoid making rash decisions based on short-term market fluctuations. The stock market is inherently cyclical, experiencing periods of growth and decline. Trying to time the market by buying low and selling high is tempting but incredibly challenging. Instead, focus on building a diversified portfolio of quality investments and staying invested for the long haul. Over time, the market tends to trend upwards, rewarding patient investors. Remember, time is your greatest ally in investing. The longer you stay invested, the more opportunity your investments have to grow and compound. Avoid panic selling during market downturns, and instead, view them as potential buying opportunities. Section 10. Seeking expert advice. If you're new to investing or feel overwhelmed, seeking advice from a qualified financial advisor can be beneficial. A financial advisor can help you create a personalized investment plan, choose appropriate investments, and guide you through market fluctuations. When choosing a financial advisor, ensure they are licensed, experienced, and act in your best interests. Look for advisors who are fiduciaries, meaning they are legally obligated to put their clients' interests first. Remember, investing is a personal journey. What works for one person may not work for another. A financial advisor can provide personalized guidance tailored to your specific financial goals, risk tolerance, and time horizon. Section 11. Conclusion. Embracing financial freedom. Investing is an essential aspect of achieving financial well-being and securing your future. By understanding the basics, exploring different investment options, diversifying your portfolio, and managing risks, you can embark on a successful investment journey. Remember, investing is a journey, not a destination. It requires patience, discipline, and a long-term perspective. Start small, stay consistent, and don't be afraid to seek expert advice when needed. Embrace the power of investing and unlock your financial freedom. With the right knowledge and approach, you can achieve your financial goals and create a brighter future for yourself and your loved ones.